Hello and welcome to the Durham Talents channel. My name is Jesse Durham. I teach people to live and leave a lasting legacy with infinite banking. In today's roundtable, we're going to be addressing a couple of subjects. Firstly, we're going to address the idea that savers might be losers. And then the second is going to be, why would I pay interest on my own money? I hope that you enjoy these themes. Put your comments below. I'm gonna jump on the segue. Tricia, you're the one that brought it up. Why, and these are maybe kind of two things, right? Why would I pay interest on my money is how people will say it sometimes in error, okay? So let's talk through that maybe. But then once people do realize that, well, I'm not borrowing my money, then let's address that topic from that direction of, okay, well, why would I pay interest at all? Why don't you kick us off?
Okay, well, I think that the big thing there is, first of all, is to recognize that you're not paying interest on your money because you're not using your money. You're paying interest to the life insurance company for the use of their money, which gets back into this idea of using other people's money as leverage. So that, and you're using the life insurance company's money for the purpose of your money being able to continue to grow and compound uninterrupted. So if you are let's just take it to the conversation we were just having about real estate with Robert Kiyosaki. He's borrowing money from someone else, from the bank or a private investor, whatever. He's paying interest back to that person in order to take those dollars and invest in real estate that's going to grow more, right? It's going to create, or at least he's speculating that it's going to grow into a greater sum. Well, in this case, we're doing the same thing, only we are in a guaranteed environment, that's what makes it different from the real estate environment, right? We're borrowing the life insurance company's money, knowing that our cash value is growing exponentially every single day without ever going backwards, continuous compounding moving forward. And that's on a greater amount of money than what we're borrowing, partly because the life insurance company does put limits on that. We can't borrow more than what's in there, right? And we're borrowing that on a decreasing amount if we are making payments back at all. So the growth outdoes the cost of that money. As long as we're an honest banker. Let me make that little bit of caveat there, right? But knowing that, then I want to borrow those dollars and go use them for the things that I need in life, because we're always financing. Just like Becca was saying, we're always borrowing, whether we think we're paying cash. One of the things that we didn't mention in that whole savers as losers thing is the opportunity cost, right? Most savers are using their own cash and they've lost the opportunity cost. So I kind of have a tendency to look at the cost of the life insurance company charging me interest. That cost, to me, borrowing from them represents the opportunity cost in some ways that I would have experienced anyways had I used cash. I just didn't see it before. Now I have to be honest with it and I get to see it. But I'm still out doing that with the compounding growth of my dollars inside of that policy. I don't know. You guys want to expound on that further?
Well, Nelson compares he uses a grocery store as an analogy. And I think a lot of people's hang up on this question is that we're misclassifying what we're doing. We're trying to compare it to another asset. We're trying to compare it to an investment when really we should be like, we're starting a business. We're starting a business. So Nelson, in his grocery store example, he has one paragraph in here where he's talking about all the operations of the grocery store and the difference between taking things out the front door and the back door and how you can be profitable with a can of peas. And he's going into all this. And in the middle of this paragraph, he has one sentence that initially to me kind of felt a little bit out of place. It says, "There is all the interest you must pay on the huge sums of money you've borrowed to buy the land, the building, the signs, the advertising, payroll and fringe benefits, utilities, legal fees, accounting, etc., to name a few." He just says that, and then he goes back to talking about turning inventory. I was like, that's interesting that he would stick that in the middle of that paragraph. But I think what he's trying to say is, if you were to start any business, you have overhead, you have costs that you have to pay. Now, if somebody came and said, man, why would you pay that's a high rent. Why would you pay that much rent on a building? Well, because I need a building to run the business, right? And if I'm paying $20,000 a month, but I'm bringing in $40,000 a month, do I care? No, it's enabling me to be profitable. So I think what he's trying to point out here is any business that you have, there's going to be a cost to get it going. You're going to have things that you have to pay for, just as in a policy loan. That policy loan interest is there, but it's just a cost of doing business. And why would you do that? Because by doing that, I can be more profitable in everything else that I'm doing.
All right, I'll give you the example that I recently used in a different video, which is think of yourself as going out to eat and you're ordering your favorite plate of food from your favorite restaurant. You're not actually just buying that steak and that loaded potato and that salad or whatever. You're paying for everything all the way back to the mortgage on that farm where that beef was raised, the hay, the grain feed, Mark knows more about this kind of stuff than I do, but you're paying for stuff all the way back to there to get to that plate of food, from the restaurant with its electric bill and whoever, is the janitor there. And just if you really stop and think about what all goes into a plate of food. One of my favorite books, iPencil, I would encourage everybody, we've had good books mentioned here today. Creature from Jekyll Island. There was another one, but iPencil's short. You can read that one with your kids. And the Tuttle Twins has a version which, our kids have read, which is really great. There's so much that goes into this right here that we don't know, right? But the consumer pays for everything. There's a lot that goes into it. So I've used that example here recently. Your favorite plate of food at a restaurant. There's a lot that goes into it.
There's a lot that goes into it, not just at the restaurant too, right? It's getting it to the grocery store and then getting it packaged and getting it cut and the labor and all that stuff, right? So it's not just the restaurant. It's more at the restaurant, right? It's more at the restaurant, but that's what you're paying for, the service to bring it to your table, right? Yeah, that's great, man. Because I don't think about that when I'm sitting there. I'm thinking, golly, why'd they charge me this much for this?
I was going to say, now I feel like it's less. It's like, oh, that's not that bad.
And again, that ties back to, the restaurant has to charge what the restaurant has to charge because of this doggone, Federal Reserve and lobbyists, influencing government officials and, other stuff.
Yeah. And like you mentioned before, it's, at face value, we think that the restaurant their expenses are going up, but who's paying those expenses, right? The price of the food going up, we're paying, the consumer is paying for those extra expenses, right?
Right.
But most people don't think about that because they think about, well, that's the cost of doing business. It is the cost of doing business, but you are the one paying for it, right? And the business owner who's effective at managing those costs and effective at marketing to the consumer and getting the consumer in the door is the ones that's going to succeed.
Right. So I think we hammered if you're making a policy loan against the cash value of a whole life policy because you're implementing infinite banking, the insurance company's loaning that money because of the value that you hold as a policy owner from other premiums that they're collecting, their portfolio of all the assets that they're invested in as this big company that they are. So we're not borrowing our money. Tricia said, we got this constant upward growth trend on premiums that we pay over our lifetime while having the advantage of that access to capital that is structured within that contract that we have. So we can't break it to the point that, the insurance company are probably not going to be lending us 100% of the cash value because they don't want it to break. We don't want it to break. They don't want it to break. There's this mutuality going on, right? They're a conservative, the most, financially conservative entity that there is out there because they're not practicing any fractional, reserve. And we, on that access to capital, have, this diminishing If we're banking and paying back policy loans and such, so that's diminishing, that's going down at the same time that we're experiencing that uninterrupted compound growth on our premiums. So if we're not using our money and not paying interest on our money, let's double tap anything more around the part of why pay a market value of capital. Like we've already been talking about the cost of capital. Tricia did a good job there. Let's talk more though about, well, if the insurance company is charging me 5% and I'm trying to do this infinite banking thing, well, what else should I consider? What else should I know? Y'all tell me.
I think you have to look at it a little differently, right? We have to look at, well, what's the volume of interest I would normally be paying if I was going to go to a, conventional third-party bank? And that's my capital, right? So I have to value my capital at a higher level, or at a minimum, at the same level as what I would value the banks. And because it's mine, because I own it, I should probably value it a little bit higher in that situation. If I'm going to be an honest banker, I should be valuing my own assets at a higher level than someone else's because they're mine. I own them. I had all the effort and time that to generate the income to be able to create that capital. So that being said, I have to value that at least the same level as what a third party would be. So let's say that third party interest rate is 7%. Well, that 7%, sure, the rate, but what's the volume of interest that I have to pay in that? I should be doing that same thing back to myself at a minimum. I know personally speaking, I typically do 10% myself. It makes it easy because I charge 10% on all the loans that I take from my own system. And that's how I train myself to be an honest banker, is my cost of capital is always 10%. And when I pay it back, that's how it gets returned. And anything that's over and above that gets, put back in as PUA, as Nelson kind of laid out in the book. But that's one of the things that it also challenges us a little bit too, knowing, well, if I'm going to take a loan, I know I'm committing to this higher level of return that I have to put back into my system as well. But I would say at a bare minimum, anybody using the system as like what we're talking about here, you should at least do that market rate, because it's all of that effort that you had to put in the first place. So you should value that money, or I should say that capital, at at least that level. Otherwise, you're selling yourself short. You're really just stealing from yourself and your future self in that situation if you don't do that.
Yeah. And then tactically speaking, what you said there is important, Rob, for the first time listener that's hearing this. So if the insurance company is charging me 5% and I'm being a good banker and I charge myself 12%, 10%, 8%, whatever I pick, if it's 10%, that extra 5% is good to go. Doesn't have to, but it's good to go in. And Nelson describes it as going into your paid up additions rider, so that your death benefit will increase and your cash value will increase and you'll experience bigger dividends than you otherwise would have because of that extra capital.
Creating more capital, right? And that's the thing that a lot of times, and that's how we have to change our mindset to think like a banker. Well, interest should be viewed as creation of new capital. And if we're not thinking about it in those terms, we're not, it's an area we have to challenge ourselves in, because I didn't just arrive at this as an idea. I had to challenge my thinking many, many times of why would I want to do that? Why does that even make sense? And I think early on in our journey, and this is really good for people maybe just starting this process, is we are not thinking in the terms of a bank. And we tend to think of it as, in Becca, you could probably really relate to this from where you were coming from. We tend to think of, well, why am I buying something twice? Why am I paying twice for something? But the problem isn't that we're paying twice, it's our mindset. It's that premium in is generating not only capital today, but future capital at a much higher level than what we can even comprehend at this particular point in time. In the policy loan itself, well, that's just repaying, somebody else's money, as we've already been talking about. We would have to do that anyway. We would have to be saving back up for the thing that we just bought. Well, if I'm properly saving, well, then I also have to save with interest. And that's really what we're doing in that case. Ryan Griggs has an amazing chapter on this in his book. And I think it's on, I actually have it here, page 138, 139, where he talks about just that whole concept of, we don't think about premium going in as capital or future capital generation. We tend to think of it, like what somebody had said earlier, a lot of people think of it as an expense. Well, it's not an expense. It's actually creating that foundation. And if $1 in today generates 15 in the future, why wouldn't I want to keep doing that? Like, we have to think differently. And that's really the biggest thing when it comes to policy loans, policy loan repayment. We have to think about, is this just a replacement of what I spent on the thing that I bought? But how am I also generating more capital in the process? And that's really what we're doing.
Yeah, that makes me think of what Brandon said earlier about how quickly time goes by, that ratio that you're talking about there. I mean, these past 10 years of me seeing IBC has gone by so fast, right? What are the next 10 years going to look like? I mean, I don't even know. I got, super high hopes. I'm really excited about what that trajectory looks like, knowing that I've already done the first. And if it's going to go by fast anyway, that's where I can get to feeling, man, let's go. Let's level up. Let's go faster. Let's do more, So there's that. I know it won't be able to be this time, but I'm wanting to field the conversation around the idea, because there are strong voices that project one way or the other online about this aspect of, well, I'm only going to borrow against my policy if I can earn this amount or that amount, this percentage, that percentage. And then even just this past week, I had a prospective client ask me, well, Jesse, on this particular debt that I have, I got this interest rate, which is lower than what the insurance company would charge right now, okay, in policy loan interest. Should I use my policy, leverage my cash value to go out and do this thing? And then of course that's where we got to have a conversation about that volume, like you were talking about earlier, Rob. So we can't field it now, but I'm just planting the seed of what you guys can expect, and that you guys of course can jump on that conversation with me as well. People are curious about that kind of stuff. I want to have that conversation. Anything else from you guys, or I'm gonna give you final words.
Man, yeah, I don't want to steal anybody else's time, but when Rob said value your money more than other people's money, like, okay, if I filter that, run my thought processes through that as a filter, I'm going to try to build my money as big as I possibly can. And I'm going to want to protect it, as much as possible. And I mean, there's no better tool that I can think of than using this strategy and using a whole life insurance policy to do that. And so, like, I'm going to operate differently. Another thing Nelson was famous for saying was, if you know what's happening, then you'll know what to do, right? And Rob just saying that right now made me write a couple of notes and made me think about that and made me go, like, there's areas where I'm not practicing that, as well as I should. So that's a huge point.
Can I take that one step further? Because I think that is really a huge point. We're the ones who put forward the labor, the blood, sweat, and tears, gave up our time and everything for earning our dollars. The bank, not necessarily, right? And yet we respect their need for interest, right? So we respect their dollars and value them when we pay them back with interest. And we just don't think about that for ourselves. So I think beyond the fact that we need to think about that for ourselves, I think we also have to teach that to our children and in our family. So when you do the whole family banking thing, it's one of the things that you get to teach your children is that the money in the family is valuable because it represents all of our time and our effort and our energy that is taken to save and to have these dollars. So let's not be robbing from one another in the family. Let's be valuing that capital just as much. So it is a very much, as a mom, it'd be easy for me to say, oh, let me just lend you my money. And this may be, I think it's important for us to teach this to younger kids, but especially adult children, right? They value the bank's money when they pay back their car loan. What if they're borrowing that from the family? Are they valuing that? So that do they understand that maybe that's why they should actually pay more interest back into the family? Because those dollars stay in the family and are important for their future as well. So I just want to throw that in there because that is definitely something that has challenged me and I've had to think through, because it's real easy as a mom to just say, I'm just going to give it to them. But we haven't taught them, when we do that, the value of our capital.
That's good. I've experienced in my sons, now that they're doing things around the house or working some with their papa at home and earning money, I'm experiencing some of these things that you're describing, where my son Josiah is talking to me about, what he wants to do with his money, how happy he is about what he earned. And then he'll be thinking out loud about, do I want to buy this? No, I'm not. No, I'm going to keep my money. So you're seeing all these things, and some's good and some needs guidance, right? And some needs encouraging. Oh no, I want to keep my money. I don't want to, but maybe I will spend some on this thing. And then us talking, because we recently made a policy premium payment for each of those two sons as well. I let them contribute some of their earnings that they've been saving up at home into policy premiums, and then that's another conversation, and then we make a deal, and there's going to be a subsequent policy loan to the premiums that they've paid with me as well, and then that's going to lead to more conversations and more interaction. So
that's fabulous. I love that you give them some skin in the game with their own policies. That's great.
Yes, I love it too. And you're so right about the adult children. I've got clients that are in that stage of, just graduated college and they're getting ready to, move out, and, they're in these different stages, and, they've been doing some conventional financing, but now they're looking at infinite banking and that car note idea. So good. So good. Anything else from y'all? Let me hear from everybody. Mark, do you have any final thoughts for us, sir?
Well, it's been a great discussion. Just one thing that, and it's going to take us back a little bit in the discussion, but during the inflation discussion, and that inflation is really just an increase in the money supply. I was driving around my little town in West Texas, 20,000 people, and I realized in the last 5 years, or COVID era, if you will, we've had about 5 new banks move into town, but our town hadn't grown that much. And it dawned on me the other day, where we used to think of, you'd see a Starbucks on every corner, like in Lubbock, Texas. Now there's a bank on every corner. And it dawned on me the other day that bankers are smart, which we know they have a good business model. There's more money out there for them to grab because of the 40% extra money supply. So they're smart enough to know, if I set up another storefront, more of that money's going to come my way. So it's been a little eye-opening to me, see how the banks have taken advantage of it. Our challenge is to take that attitude with our capital and grow our system. Okay, let our money supply increase, just like we watch the banks take advantage of the money supply increase.
And for every American home that pursues infinite banking, Mark, and achieves financial independence and autonomy for themselves, it's a victory, it's a win, and I'm so thrilled about it. And that's what we're all here for, is we're here to help people do that. But then for those people that can think beyond ourselves as well with us, the more that we create that independence at that me and you level, the more we're going to shrivel up and contract and go closer to a sound money system. taking that advantage away from these banks. So, man, that's good. Becca?
Yeah, there's the more I learn, the more I realize I need to learn, I think I would say. There's so much wisdom in this book, in these 92 pages. And rethinking our thinking, I think, is probably one of the most powerful things we can do. And not taking the systems of the world at face value is just, this is normal, this is what you're supposed to do. One of my favorite scriptures in relation to becoming your own banker is Romans 12:2, where it says, don't be conformed to the patterns of the world, but be transformed by the renewing of your mind. And I think that's what Nelson was saying. Don't just go along to get along because that's what everybody does. Think about what you're doing. Is it doing what you think? Is it aligning with your values? Is it benefiting you and your family and the stewardship responsibility that we all have? Are our actions lined up with that, or are we just going with the flow and we don't ever think about it? So renew your mind, rethink your thinking. That doesn't mean you have to do this, but I think it's important to understand the difference and understand the change that could take place in your life by implementing a process like becoming your own banker.
And now, for all of you that don't know, you can see an interview from Becca with the Infinite Banking Initiative podcast, where she's talking with David Stearns on the podcast. It's just really neat. I've listened to it. I really enjoyed it. So I would encourage everybody to go check that out. Lee, David, Becca, they're talking. Great thing to go and see. Tricia, final words from you.
Well, could I just make a shameless plug here for a second?
That's right. I've already followed you on Instagram now. I think is where I've already seen.
Well, and I don't even mean that. No, well, yeah, no, my business has changed to Thrive Well. So I have all of that. But really, I just am so want to educate people on this stuff. And I just found, not only have I been reading this book, The Creature from Jekyll Island, but I just came across this resource as well, The Money Masters. It is a complete history of banking, and it literally starts at the time of and before the time of Jesus and why he was chasing out the money changers out of the temple. It's extremely fascinating. And when we were having this whole conversation about inflation, I mean, the fact is that people need to understand what this is all about. In fact, I'm just going to read you a quote in the back. It's a quote from Thomas Jefferson. It says, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people to whom it properly belongs. And I just want to say that using the infinite banking concept is one small way that we can begin to do that. And I don't think people realize why they're struggling so bad is largely due to this situation that we find ourselves in today. So educate yourself, read some books, take some time. It is worth the understanding, along with, as Becca said, becoming your own banker. So there's my shameless plug. I really want to encourage people to understand what's really going on so they'll know what to do.
Wield your independence, people, for your sake and for your children's sake. Well, so I should have known better. Of course, you were going to be selfless and promote us to the most recent book, great book that you've been reading. But you've got a lot of great things going on in your business and your reaching, and everybody's contact information is going to be in the show notes. You need to check out these interviews that I've had with everybody that's on today to get their background, to learn more about their experience, their expertise. They're actively helping people all across the country implement this concept. So you can watch those introductory interviews with them. You'll be able to reach them there as well. Rob, let me give you a chance for final words, sir.
Yeah. Obviously a great discussion across all the different areas today and a lot of great insights from all of you. I would say that one of the things that I tend to look at in this type of a conversation is, and really goes back to some of what we were talking about, was just controlling the environment. When we can take and operate within 100% reserve system, we're at the forefront of that. A lot of people are not thinking this way. When we start operating within the realm, within the context of becoming your own banker, we are actually doing the right thing, the truthful thing with our money, in putting it into action. We're not contributing to that fractional reserve system, and we're actually helping to reduce that over time. Now, if we can do that for 10 other people, 100 other people, 1,000 other people, we continue to expand, and maybe we can get it to a point where, like Mark was talking about, where there's a bank going up on every corner, maybe we can cut that down. And again, I have nothing against the banking industry. They're doing what's within the scope and realm of what they're capable of, and they're trying to make money, but they're doing it on the backs of everybody else. In that fractional reserve system, whoever gets to use the money first is the one who profits. And that's generally government, connected people within the government, and banks. Outside of that, we all have to pay for it. So if we can be in the situation where we don't have to operate in that situation, we then create a much better system for ourselves, our families, and if we're thinking long range, 3 generations down the line, 5 generations down the line, of people who never have to operate in this system. And that's exciting to me. And I know that that's exciting to a lot of other people. So I look at it as, this is a great foundational learning experience for those who maybe aren't used to what we're talking about, to hear from or hear things from a different angle, where maybe we can put our money in a place that is going to allow us to be in a much more successful position long run, where we don't have to ever have our kids go through learn the hard lessons like we have, and those types of things, right? So I just look at it as a great learning experience all the way around.
I love it. Brandon, give us a parting word, brother.
All right. Yeah. So IBC is a cheat code in financial world in your life, right? So I think we can all agree, and we've said it several times today, even, that when the US dollar was backed by gold, it was a much more stable economy, right? When you practice the infinite banking concept, you're creating 100% reserve system for your family's economy, which is a much more stable system. So protect your family, protect your finances. They're using the infinite banking concept. And Nelson even talked about, it takes people somewhere around 20 years to get to this point to where they can actually flow all of their annual income through their own private banking system. And just imagine if every dollar you made throughout your entire life, you put it into a big storehouse, a big warehouse, then you collateralized it, while it still continued to grow, and you still continued to use the money you needed to do the things you needed to do in life, but yet you were still protecting and growing that and completely having 100% reserve to do so. And how stable, how freeing, how much control you have back in your life to kind of step off the treadmill that society's put us on, and, just trying to keep up. So anyway, let's create our own 100% reserve in that fashion. That's what I would encourage everybody to do. And it's provided me and my family so much security and safety.
I love it. Well, these conversations are always a blast for me. Thank y'all so much for being here. Again, everybody's contact information is going to be below in the show notes. I would encourage you, if you're not actively working with somebody, we're here to help. If you'd like to unplug from the conventional financial matrix, you can find me at durhamtalents.com. If you have thoughts or suggestions, feel free to put that in the comment section below. And my hope is that you do live and leave a lasting legacy. Have a great day. Take care.
I just have one shocking kind of statistic that I don't know if it's true or not, so I didn't want to say it on the recording, but that I don't know if any of you guys watched that interview with Richard Werner with Tucker Carlson maybe a couple weeks ago. He had a white paper that he referenced in that. So I downloaded the white paper basically about why banks can create money and nobody else can. In that white paper, he says that 95% of money creation is not done by the Federal Reserve, it's done by the banking system. And so when we look at, the Federal Reserve printed 40% more during COVID, that's like a drop in the bucket compared to what the banking system is creating and adding to inflation. And so I was like, wow, that's kind of mind blowing to me. Anyway.
You know what's worse to me than the inflation is the more I'm reading, the more I feel like it's blood money. It's our wars are all done by this. Like, why do we want to participate in blood money? Like, this is like, I'm going to wind up sounding really extreme. And I worry about that sometimes on social media, right? Because I don't want people to dismiss me because they can't handle the truth. But like, when I'm reading this stuff, I'm like, inflation is the least of our problems with the banking system. It's killing people.
I love how you worded that. That was so funny. You can't handle the truth.
Well, I'm afraid people think she's too far out there, man. We're not working with her.
Listen, you're number one. Everybody's beneath you, Tricia.
It's just been making me so mad as I've been reading this. I'm like, oh.
I'll tell you another verse that's been reverberating through me here recently that I've shared with people that's been a help to me. I love when Job said, "He knoweth the way I go, and I shall come forth as gold." I love that verse. I absolutely adore it.
Where is that? Sounds like a good one to know.
In the book of Job, I just said. I don't remember chapter and verse. I'm sorry.
Job. I thought you said Joe said.
I'm sorry. Yeah, no, Joe didn't say anything that good.
I was like, wow, that's good.
No, you can tell him I said so. He's not Job level good. Yeah, the book of Job. He knoweth the way I go or take. He knoweth the way I take, and I shall come forth as gold. I love that one.
Tricia, you can't say that you're the only girl anymore, right?
I know. I was so grateful when I saw that you were saying I can be there. I'm like, yeah, it's another girl.
There we
She's
go.
belly aching about that. No, I'm just kidding.
Be with all the boys by myself, All right, I can hang.
I was going to say, you were doing great, so I don't know what you were worried about.
Not a thing.
Yeah, it is too bad Joe's not here to keep y'all company. Yes, that was a joke about making him feminine. You can tell him I said that. That's okay.
I got it.
Thank you, Rob. I think Becca's chuckle was unsure, so I was definitely digging
I'm
at
a little
Joe.
slow, but I
That
caught
was
you.
a courtesy laugh, right?
Yep, that's fine. That's why I said I don't mind explaining some things, just so the word will get around to him, so he'll feel the love. Y'all heard a recording when y'all jumped in, right?
Yes.
Oh my goodness! All right, well here's what I just did. I definitely just gave an intro to a camera that wasn't rolling. It was on, so I'm like, oh, okay, I see me, so I'll just give my intro. That's dumb. All right, now, do you want to take your compliment back, Becca? Yeah, do you want to take back what you said?
Nope, not at all.
Man, okay, it was a good warm-up. It was a stinking good warm-up, I guess. If while you were listening to this video, you were inspired and you thought of someone in particular, send this video to them. Let it be something that they can watch and that you can talk about. And my hope is that you do live and leave a lasting legacy.